early stage venture capital. Early stage. Companies that are seeking investment capital are at various, considered to be at various stages of capital, depending on how much they've de-risked their company, how much they are ready to receive investment capital. And so there's something that's called seed stage, there's something that's called early stage, there's something that's called growth stage, and then there's something called late stage. So early stage is right there in the middle, really, of a startup's existence. It's considered the Series A and Series B rounds, which are effectively the validation and product market fit growth rounds of a company. So typically at the Series A stage, companies are receiving between, say, $5 and $20 million in capital, a substantial amount of money. And these are companies that, in order to receive that level of capital, have already de-risked their businesses to some large degree. They've already gotten product market fit, they've already had some customer sales, but they haven't necessarily proven it over and over and over again. And so it may be a company at $1 million, $2 million, $3 million in revenue that gets a Series A round. A Series B round is typically given to a company that already has had a Series A round, already has many customers, and has repetitively shown that all it needs to do is grow more to increase the profitability of the business, and has a profitable product margin contribution on each additional sale of the company, typically at a Series B stage. So those combined, Series A and Series B, are often grouped into the term early stage capital to differentiate it from later stage growth, C, D, E, F round, and late stage would probably be the E and F round, as the company is prior to going public. At every stage of the company, it's very typical for the company to give up 20 to 33% or 35% even of its equity for an 18-month of runway style investment. Now, I said that there was between $5 and $20 million worth of capital that would be raised at a Series A. And you may think that if you only get $5 million of capital versus $20 million of capital, that you may be giving up less equity. That's not necessarily true. It's probably not true at all. You really give up around that sort of 20 to 30% of your company for every year and a half that you are relying on investor capital to fund your business rather than customer revenues to fund your business. So that's the risk that you're giving. And the reason why people will give more money is because they're more sure of the outcome, or because the opportunity requires it. And that's why they give that additional capital. And they'll get the same percentage of the company, just relative to the risk and the time that's involved to take your company from a Series A to a Series B to a later stage growth company. That is early stage venture capital. Early stage! To see more about other stages of the company, we have other definitions for seed stage, growth stage, and late stage capital. VC Lingo. Lingo.